Risk versus reward, how do you balance them? So balancing risk versus reward, it comes from really two schools of thought. It's the risk on your time and it's the risk on your money. And when you're going into any investment, but especially in property investment, you need to make sure you're drawing down on both. So let's start with research and due diligence. You need to do your research and due diligence, not just on the area, which I'll talk about in a moment, but also on the local demographic, the trends, the socio-economic factors, and crime in the area. So when you're looking at these stats, it's not so much the stat on its own that makes any sense. For example, if you go on property data or street check or something like that, and you check crime in your area, you would be dissatisfied. Crime is absolutely everywhere. Genuinely, there's so many crimes on your street, and I know that without even knowing where you live. That sounded a bit weird, didn't it? Anyway, it does. Check it out. Now, it's not the stat on its own, it's when you compare it to another area. For example, you're going to have the types of properties that go up and down in the area. You need regeneration in the area. You need growth factors in the area. You need transport linked. You need existing property, developments going on, and all of that contributes to the overall data. But the research and due diligence is the key part. And actually at Aspire, we have around 56-point checks that we've trademarked under something we call target criteria. Now, you of course will set your own criteria, but make sure you've got a systematic way of approaching every single investment. Next is location, location, location. How many people stole that line, right? So location matters. The amount of time an investor will come to me and they'll go, Jamie, I managed to get a 10% discount. It's like, oh, that's amazing. Where is it? Kind of don't want to say a place in case you live there. I'm probably not that worried about offending you. And I'm like, that is a shithole of an area. And they think, brilliant, I saved 5 grand, 10 grand on my property. I'm like, yeah. But over 10 years, you've sacrificed hundreds of thousands of pounds. Approaching things from a below market value is a stupid, novice, naive way of investing in property. Instead, you should be focusing on the value position. The value position being finding something that is around good or outstanding schools, great transport links, strong city centre fundamentals, wealth, development, infrastructure, government support. Are they in an investment zone in the UK, an entrepreneurship free zone that's going to encourage the growth of that throughout? What's the average earnings in the area? How much earnings per price of the property is in the area? All of that's going to dictate the strong capital growth that really is 85% of the money you will make in property. So location really does matter. Market conditions. You need to understand your market conditions. So this is a bit of a macroeconomic factor rather than micro. And what I mean by that is it's not just to do with property, it's the overall impact of the economic climate. But if you don't keep your eye on industry news, you will miss out on the fact that Liz Truss came in and kind of fucked everything up. Nice one, Trussy, baby. And you've also got the EPC changes where everyone's like, oh my God, the energy performance certificate, this can happen. Prices of property went like that. They were never going to fucking come in, by the way. Then our man Rishi Sunak, the everyday prime minister, maybe not, comes out with the revelation, oh, by the way, we're going to scrap that stupid scheme. What then happens? Boom. Property prices go up. But if you didn't understand the market, if you weren't analysing that, if you weren't looking at things like Section 24, EPC changes, new regulations coming in because of the separation through Brexit, we've got renters reform and everything in between, you're missing out on a lot of money. Number 4, financial planning. Set realistic budgets, okay? So when you're going out there, it's very easy to go, all right, how much is a property? £100,000. Then I need how much deposit? Oh, 25%. So that's £25,000. Now I've got £30,000, so I can buy a £100,000 property. No, you can't. You roughly need, in a solid area, like a area, in my opinion, worth investing in, the absolute minimum you're going to need is 45 grand per property. Ideally, you can start building your portfolio with £100,000. But you need to do your financial planning because there's nothing worse than buying something and then not having the funds to deliver. The amount of properties that I pick up on the cheap with a little bit of a drink in it, for me, is when somebody's purchased something, they are developing it out and they've run out of money. Silly. Which brings me to number 5, which is diversification. Multiple streams of income. The average millionaire has 7 streams of income, did you know? And there's a lot of course providers out there that will talk about all these multiple streams that you need, and it's fucking stupid. Okay, now listen out. Yes, multiple streams of income are great when you have other great streams of income. It is moronic, people going, the amount of times I see it, I'm going to do a bit of this, a bit of that, a bit of this, and a bit of that. I'm like, it's incredible, great idea. How many have you bought so far? 0. Fuck all, Jamie. It's like, all right, nice one, yeah. So how about we start with a single form of income, and then we might get a second form of income in 5 years' time, and then you build it out and build it out. Just so you know, by the way, I have a net worth of multiple millions, and I have about 3 streams of income. Okay, and 2 of those are in the last 2 years. So I become a multimillionaire through 1 stream of income through property. So you don't need multiple streams of income and diversification. Warren Buffett says this really well, actually. He's like, only idiots need to diversify. And I was like, that's interesting. And his whole thing was, only an idiot needs to buy, in his case, 20 different companies because they don't really back them. A smart investor does their full due diligence, understands the fundamentals of business, and goes all in. That is what we should be doing in property. And by the way, if you're new to property and you're within your first 5 properties, you should absolutely be getting a boring, vanilla buy-to-let property. And by the way, if you've got 100 grand and you don't have the time, the experience, or half of this knowledge that you need to make it a successful investment, that's where I come in. We actually help investors just like you, busy working professionals that want to build this up but get it right the first time. The way we do that is we help you build your portfolio. So if you've got 100 grand or even 50 grand or more and you want to start that portfolio, put APG, Aspire Property Group, APG in the comments right now. And if not, I'll put a link in the comments. I'll pin it to the top. Fill in your details and we'll have a one-to-one chat and see how we can help. Number 6, rental yields. Yield's really important, kind of. Yield, by the way, just so you understand what gross rent is let's say you've got £500 a month rent, you times that by 12 months, you got 6 grand, and you're buying a 100 grand house, £6,000 over 100,000, 6% yield. That is what a yield is. In general, I really like operating in the 5 to 7% yield range. Now, some people are like, I've got a 12% yield. And it's like, yeah, but you don't need to tell me where your house is. It's in a shithole, okay? And I would never fucking ever buy a 12% yield buy-to-let property. Ain't gonna happen. 5 to 7% is a really good indication of risk. And by the way, if you don't know what yield is, it is a measurement of risk against something called variance squared, which we're not going to go into, it's too geeky and my team have a go at me for being a geek already. So yield is a reflection of risk. Basically, if property prices are really low and rents are really high in relation to it, that's a really high risk demographic because no fucker wants to buy property and live there. But people don't fucking think of it like that, do they? Because it's just yield. 5 to 7%, I'm telling you, that is your sweet spot. Number 7, your legal and regulatory considerations. What I mean by this is property is an ever-changing market and you can tap into that as a valuable resource. So for example, if you think you were a landlord 20 years ago, in the heyday as they say, where everything was easy, basically it was. You go in and the bank would go, do you earn enough money for this? And you go, how much money do I need to earn? 50 grand a year. Yes, tick this box. There you go, you've got the money. Honestly, not too dissimilar to that, by the way. Crazy, right? But it will come back round, I promise you. You need to understand a lot of things change. And so if you understand how the change impacts certain individuals, you can then advertise to those individuals, tap into it and get a great opportunity. But you also need to be ready for it. So for example, when all of the law changes come in with lettings management, which is loads, by the way, trust me, I own a lettings management company. You've got all this regulation that if you don't get it right, you won't be able to exit the tenant. So if you don't keep up with all of this regulatory change, you're going to be in with a pain in the arse. And honestly, lettings is where all the regulation really is. So outsource that fucker. Number 8, your exit strategy. You need to have the exit in mind. Remember, you make your money when you buy, but it's the exit that makes your money. Now, my exit overall is death. Yes, I know that's morose, but what I mean by that is I'm going to use the most typical death pledge, if you didn't know that's what it stands for, which is mortgages. The mortgages are all to do with your death pledges, which is really weird when you say it like that, but that's all it is. It's a debt. And the reason we love debt, good debt, this is not bad debt, we love good debt, is inflation erodes the money for you. Inflation at the time of filming is what? Anything between 6 and 8%, dependent on who you believe. And we're only paying 5%. So if we're getting charged 5%, but inflation is eroding the value by 8%, you're getting paid to have the debt. Not only that, you can leverage it. Not only that, you don't pay tax on it. So people go, yeah, but you're going to pay more money. It's like, yes, but as the value of the properties go up, rentals also go up, so it's covered by that. So because my exit is death, capital growth areas are way more important than the high yield areas, because I don't care about the extra 50 quid a month. What I do care about is the extra doubling of my investment every 10 years. And you should be thinking that too. So if you're a short-term investor, you might want to go for higher risk strategies like flips, BRRs, all of that, which are higher risk. Or if you've got a longer term mindset where you're thinking, I want to retire a multi-millionaire, then boring vanilla buy-to-lets is where you need to be at. Number 9 is risk mitigation. I'm going to make this one quick. Think about having a second exit. So many people go in with, right, I'm going to own this, but what if you needed to sell it? What would you do? What would be your route? The cool thing for our investors, by the way, is if an investor ever wants to sell their property, which, to be fair, we do about 200 plus a year. It might be 1 a year, so incredibly low amounts of people. But the cool thing is we can buy it back off of them. So it makes them feel really confident in the fact they're always going to have a buyer, which could either be one of us or one of our other investors. But make sure you're not just looking at how much money you can make. You want to look at the potential downside. What are the risks and how can we mitigate them? And finally, Diaz, number 10. Have a long-term mindset. It is fucking ridiculous how many times I see an investor go, no, I don't think I'm going to buy right now because the interest rate might go up and it might do this. And I go, oh great, when are you looking to sell the property? I'm never looking to sell. How old are you? 30. Are you looking to die in the next couple of years, sir? No, I want to live till I'm 70, 80, 90. It's like, cool. Then why the fuck do you worry about the economy today when you should be focused on the economy over the next 50 or 60 years? There has never, ever been a 10-year period where property prices have gone down. If in doubt, zoom out. This is why capital growth areas are so friggin' important, is that you don't make investment decisions in property based over a year or two. You have a 10-year vision. That's why if you ever come on as an investor at Aspire, and again, by the way, if that is you, put APG in the comments and we can have a chat. But when I present to you, or the team presents you the opportunity, we do all of our economics and analysis over a 10-year basis so you can actually see it. And on average, by the way, at Aspire, we treble people's initial investment within a 10-year period. And you might think, no way is that possible in property. Yes, it is, if you know what you're doing. So hopefully this has been helpful. If you thought, shit, that was a lot of information, believe it or not, that was me rushing through the video because this could be a 3-hour video, as you probably figured out. The truth is, not many people do have the time, inclination, experience, or even where to look in this. And that's really where we come in. If you've been watching this and you know you want to invest already, hopefully you've got a bit of trust if you're being on the channel for a while, and you want help, make 2024 your year by putting APG in the comments. I'll put a link, I'll pin it to the top. Take action. If you're new to the channel and you just want to learn, you want to immerse yourself in this a lot more and really make property your side hustle or your main hustle in 2024, make sure to hit that subscribe and the notification bell, and I'll see you in the next video.